Today we selected and summarized 8 important articles from the Wall Street Journal and the Financial Times for you. Here are the headlines. WeWork endeavors to secure funding amidst competition from its former CEO Adam Neumann, who seeks to outbid rivals, while Google faces backlash after firing 28 employees for protesting the company's cloud deal with Israel. Meanwhile, cocoa prices soar to record highs due to a worsening global shortage, prompting pension funds to withdraw hundreds of billions from stocks. Amid escalating tensions, Iran issues a warning of a potential shift in its nuclear stance if Israel threatens its atomic sites. In the real estate market, buyers regain control as luxury home sellers cut prices, while Blackstone highlights the slow process of private equity returning capital. Additionally, TSMC, Nvidia's main manufacturer, intensifies its focus on AI chips in response to increasing demand. Now let's get into each article.
WeWork, undergoing a strenuous effort to secure funds and evade a sale as it navigates through bankruptcy proceedings, encounters a significant development with its former CEO Adam Neumann re-entering the picture. Neumann, via his new property venture, Flow, has made a noteworthy conditional offer of approximately $600 million for WeWork, signaling his eagerness to reclaim control of the company he co-founded. The urgency for WeWork to secure fresh funding arises from its pressing need for additional capital, estimated at up to $400 million, to navigate through bankruptcy and potentially emerge as a financially viable entity. Without this injection of funds, the company may be compelled to explore the possibility of selling itself, highlighting the critical juncture at which it finds itself. Neumann's offer, amidst WeWork's financial complexities, introduces a new dynamic to the situation. It not only underscores his continued interest in the company's fate, but also presents a compelling alternative to other potential investors. However, Neumann's proposal isn't without its skeptics, given his tumultuous tenure as WeWork's CEO before stepping down in 2019. Furthermore, WeWork's aggressive approach to restructuring its lease obligations, which involves withholding rent to renegotiate terms with landlords, showcases the lengths to which the company is willing to go to alleviate its financial burden. While this strategy has yielded some success in reducing long-term lease commitments, it has also contributed to cash flow challenges, exemplifying the delicate balancing act the company faces in its bid for financial stability. Amidst these developments, other potential bidders, such as Rhythm Capital and Access Industries, have engaged in preliminary discussions with Neumann, indicating a broader interest in WeWork's future from various quarters. However, the intricacies of WeWork's financial restructuring, coupled with the complexities of bankruptcy proceedings, present significant hurdles that must be navigated carefully by all parties involved.
Google has terminated 28 employees who participated in protests against the company's cloud computing contract with the Israeli government, citing the demonstrations as unacceptable and extremely disruptive. Vice President for Global Security Chris Racco stated in a company-wide email that the protests made co-workers feel threatened, leading to the dismissals. The group behind the protests, No Tech for Apartheid, accused Google of prioritizing its $1.2 billion contract with Israel over its own workers. The protests included sit-ins and demonstrations at Google offices in New York and Sunnyvale, California, resulting in 9 arrests. Protesters demanded the cancellation of Google's contract with Israel, alleging complicity in genocide against Palestinians. Google, however, defended its contract, stating that the cloud services provided to Israel were not for sensitive or classified military purposes. The protests were triggered by a Time magazine article revealing Google's involvement in the Nimbus contract, which provides cloud services to the Israeli government in collaboration with Amazon.
The price of cocoa hit a record high as a report revealed crop failures in West Africa, worsening the global cocoa shortage for chocolate production. London futures surged to £9,477 a ton, marking a 9.6% increase amid concerns over poor harvests in key growing regions. The European Cocoa Association reported a 2.5% drop in cocoa grindings, reflecting the industry's struggle to find sufficient beans rather than a decline in chocolate demand. Industry insiders attribute the grinding decline to the scarcity of beans, with West African factories operating below 30% capacity due to the bean shortage. Cocoa prices in New York soared to over $10,800 a ton, driven by challenges faced by farmers in Ghana and Ivory Coast, the world's top cocoa producers, including disease outbreaks and adverse weather. Both countries are renegotiating contracts to delay deliveries due to the bean shortfall. Ghana and Ivory Coast increased set prices for farmers to incentivize plantation investment and boost yields. Despite the short-term challenges, higher cocoa prices may encourage long-term planting efforts to meet global consumption growth.
Pension funds are reallocating their portfolios, with many shifting away from stocks into bonds and alternative investments amid a backdrop of record-high equity markets and rising interest rates. Large corporate and public pension funds, including California's Public Employees Retirement System, are planning significant moves out of equities and into private equity and debt. This shift reflects a broader trend as investors seek to balance risk and returns in a low-yield environment. While stocks have performed well, concerns about potential losses and the need to cover future obligations are prompting pension funds to reevaluate their asset allocations. Goldman Sachs analysts estimate that pensions will divest $325 billion from stocks this year, up from $191 billion in 2023. Corporate pension funds, buoyed by a surge in stock prices, are diversifying their investments, with stocks comprising less than a quarter of their portfolios. State and local government pension plans, meanwhile, are adjusting their allocations to maintain funding levels for future pension promises. For example, the California Public Employees Retirement System is reducing its stock allocation while increasing investments in private equity and debt. Similarly, the New York State Common Retirement Fund is shifting toward private equity and real assets after a change in state law. The Alaska Permanent Fund Corporation is also reducing its equity exposure, citing concerns about stock market valuations. These moves signal a broader trend among pension funds to reduce risk and ensure long-term sustainability. As interest rates rise and stock valuations remain high, pension managers are prioritizing asset preservation and income generation to meet future obligations.
Iran has issued a warning to Israel, indicating a potential review of its nuclear stance if its atomic facilities face threats. This warning followed an Iranian drone and missile attack on Israel, escalating tensions in the region. Major General Ahmad Haq Talab, overseeing Iran's nuclear security, suggested that Iran might reconsider its nuclear doctrine and policies if Israel targeted its nuclear sites. The warning coincided with the US and UK imposing new sanctions on Iran's drone program in response to the recent strike on Israel. US President Biden emphasized a collective effort to increase economic pressure on Iran, vowing necessary actions to hold Tehran accountable. Additionally, the UK announced sanctions against Iran's defense minister and entities linked to its armed forces. The escalating tensions between Iran and Israel have raised concerns about a potential regional conflict, prompting warnings from EU officials urging restraint. Despite Israel's pledge to defend itself, Iran vowed retaliation against any Israeli strike. The strained relationship between Iran and the US since President Trump's withdrawal from the 2015 nuclear deal has further complicated the situation. Efforts to revive the nuclear agreement have faltered, leading to increased nuclear activities by Iran. However, Iran expressed willingness to commit to the 2015 deal if other signatories fulfilled promises to ease sanctions. The article underscores the precarious nature of the situation and the potential for further escalation in the already volatile region.
Luxury home sellers are facing the reality of reduced asking prices across the country, marking the highest level of price cuts since 2017. Tech entrepreneur John Hunter and his wife Lori initially listed their European-style Phoenix home for nearly $11 million in April 2023, but are now preparing to slash the price to around $8.7 million due to a lack of offers. Similar scenarios are unfolding nationwide, especially in luxury markets that saw significant growth during the pandemic. Sellers are readjusting their expectations as prices return to more realistic levels. Cities like Austin, Texas, have experienced a surge in luxury price reductions, with a notable increase in listings priced at $1 million or higher. Buyers are becoming more discerning, focusing on value and taking their time with decisions. Luxury sales have seen a decline overall, with activity swinging back in the first quarter of 2024, but remaining below pre-pandemic levels. Sellers like retired executive Ron Wolf have adjusted their pricing strategies, recognizing the need to adapt to changing market conditions. In this market, presentation is key, with sellers needing to put effort into showcasing their properties effectively to attract buyers. Despite challenges, sellers remain hopeful of generating interest and driving prices up through strategic pricing and marketing efforts.
Taiwan's leading contract chip manufacturer is significantly expanding its capacity for AI-related chips in response to surging demand, particularly from companies like Nvidia. Despite efforts to ramp up production, TSMC's CEO acknowledges that current capacity still falls short. Historically reliant on smartphone chip manufacturing, TSMC has pivoted towards AI-related technologies due to market saturation in smartphones. The collaboration with Nvidia, a major customer, has propelled TSMC's shares upward despite sluggish demand in other chip sectors. Advanced packaging, crucial for AI applications, is receiving increased investment from TSMC, with its flagship technology being chip-on-wafer on substrate, CoWoS. This packaging method enhances data transmission speed, aligning with the demands of AI computing. Nvidia's AI chips, utilizing CoWoS, constitute a significant portion of TSMC's advanced packaging capacity. Recognizing the persistent demand for energy-efficient computing, TSMC is doubling its advanced packaging capacity this year. The growing importance of chip packaging is evident in global investments, with the US government allocating substantial funds to the field. TSMC, alongside competitors like Samsung and Intel, is at the forefront of this technological shift. While advanced packaging is currently prevalent in high-end computing, efforts are underway to expand its usage across various sectors. TSMC's investment focus includes advanced packaging, reflecting its strategic importance in the semiconductor landscape. However, plans for advanced packaging facilities outside Taiwan remain uncertain, with TSMC preferring collaborations with US-based companies like Amkor Technology.
Blackstone, the world's largest private equity group, anticipates a gradual process for returning capital to investors due to a surplus of unsold assets, despite a resurgence in mergers and acquisitions. Jonathan Gray, Blackstone's president, emphasized the ongoing recovery phase, stressing that capital return doesn't happen immediately. The firm expects increased deal activity as financial markets loosen post 2 years of subdued IPO and takeover activity. Lower corporate borrowing costs and heightened bond issuance contribute to this momentum, although investors are adjusting expectations for central bank rate cuts. Private equity firms anticipate leveraging falling interest rates to facilitate exits from $3 trillion worth of unsold investments, ultimately allowing for cash returns to investors. However, the pace of this process remains uncertain amidst shifting economic dynamics, including delayed rate cuts by the U.S. Federal Reserve due to strong economic indicators and geopolitical tensions. Gray remains optimistic, expressing confidence in market resilience despite ongoing uncertainties. Blackstone's first quarter earnings slightly surpassed forecasts, driven by significant new investments but offset by a decline in asset sales. The muted sales impacted performance fees earned from profitable investments, leading to a decrease in overall cash flows. Despite challenges, Blackstone's credit and insurance business experienced robust growth, contributing to the group's total assets reaching $1.1 trillion. Additionally, wealthy individual investors injected billions into Blackstone's funds, reflecting continued confidence in the market. Gray foresees market conditions improving further, notwithstanding geopolitical uncertainties, attributing a degree of desensitization among investors to recent geopolitical shocks. That concludes today's headlines. If you found this video helpful, please consider subscribing to our channel.